in early Asian trade, up over 1.5%, trading at 63.68. The reality is, with this oil market, it just can't stay away too long from $65 a barrel. It just somehow gets the jitters, and whatever happens, it always seems to retreat there. Let's kick off this morning with Michelle Weiss-Buchmann, who is enjoying a very nice cup of coffee, senior maritime intelligence analyst, of course, with Windward, who we missed terribly in Fujairah recently, but we survived with her delegated replacement, who was excellent. So thank you, Michelle, for arranging that. Your thoughts? Obviously, we saw a big drop in the oil markets at the end of last week. On the news, it would appear, and I'm sort of confused whether it was so much or not to do with ceasefire in Gaza or reignition of the trade war with China. Your thoughts this Monday morning as the oil market recovers a bit? What are the greater forces at work here?
Oh, good morning, Sean. I can only assume that once again, geopolitics is having its impact on the market. And of course, we have not only the words between the Chinese and US president, but there's also the retaliatory port tariffs that China has threatened to impose on US-owned vessels. And we're actually seeing that play out in the shipping market over the weekend. So not only is the oil market right in the thick of things, so is shipping.
And on the shipping side, obviously, we've got a few things to watch here. Obviously, the trade war will come to, but I just wanted to get an update from you on the much more concerning conflict that is obviously now the Russian attacks on Ukraine, the increasing targeting of energy infrastructure. That conflict, as hopefully something is getting under control in the nightmare of Gaza, but in Ukraine, there seems to be escalation. What's your assessment there, and flows out through the Baltics?
Well, when you step back, the Ukraine drone attacks on Russian oil infrastructure has had two impacts on the industry. First of all, it's seen partial disruption of diesel exports. But when I look at September figures of Russian crude exports, that's obviously resulted in more crude to export. And despite the imposition of an EU and UK lower price cap for the month of September, when you look at the fleet composition and the tanker movements out of the Baltic and the Black Sea and the Arctic and the Eastern Pacific, they have been relatively unchanged. From a maritime security perspective, well, we have much greater concerns there, not only for the possibility that some of these dark fleet, shadow fleet vessels are being used as launch pads for drones, but also, again, those usual safety and environmental factors, because these ships are effectively floating rust buckets. And so those concerns have not diminished at all, even though they have been, certainly from a geopolitical global perspective, been overtaken by events in the Middle East and also the resumption of the tariff trade wars between China and the US.
Let's go to China with Victor Yang, senior analyst at JLC Network Technology. Victor, I think we had all sort of been lulled into a false sense of slumber with the trade wars, the big drama of Q2 and Liberation Day, and then through the second quarter, it seemed like China and the US had found some kind of a pause or a détente, and then now we're back in the thick of it. Your thoughts on where this goes? What is China's position regarding the sort of face-off with the US?
Well, yes, well, first of all, when we came back from the holiday, things were kind of, well, worse than before. I mean, busier, a lot to do with the sanctions, because of the sanctions. And China's position is that it's open to talks, as it has reiterated a few times. But at the same time, it does not accept the United States threatened. Well, let's say before October, the United States sanctioned Chinese companies entities very frequently, and the latest about 15 entities, including some terminal. And China said it did not accept any threat before or around the talks. So that's not the way to deal with China. So if the United States wants to talk to China on the trade, so it will be open to talks. But at the moment, we do not see any improvement
I
before
suppose
the
the dynamic of the I don't know if manners is the right word, but I suppose much of the world has got used to being slapped around a little bit by Trump, being insulted by Trump. Even in the case of the Canadian Prime Minister the other day meeting in the White House, one minute Trump is praising him or Canada, and the next minute calling him nasty. China doesn't accept those same approach to that kind of Trumpian insult. Is that a big factor in this dynamic, the sort of the behavior of Trump being as much an obstacle as the policies?
well, we could say that first of all, during the trade talks, there was some kind of requirements from the United States that China did not accept. And it's not an equal talk. So to put it this way, so what China wants is an equal playing field. So to create a level base for talks, but that's not the case now, and it's not going to accept the bullet from the United States any longer. We could say that.
Sorry, just I didn't catch that last word. It's not going to accept the bullying.
The
Is that what
bully,
you,
yes,
the
yeah,
bullying? Right,
yeah,
right.
yeah.
The getting out in front of that. Let's welcome Omar Najia, who has managed to join us by audio, which is great, Omar. Appreciate that. I know you're out of Dubai at the moment, but I wanted to get your take on this sort of flip-flop in the oil markets that we've seen in the last few days. We saw a big sell-off before the weekend. Now we're seeing a relatively sizable recovery this Monday, Asian trade. Your thoughts on that, and how big a factor the dynamics in the Chinese-US relations that Victor was just talking about is impacting that volatility?
Oh,
Look, I think uh, that volatility is definitely there, and that impact is massive. And it's basically dependent on what Trump says from one day to another. Now, it's no accident that he says this kind of stuff on a Friday. So basically, all markets melt. And then on the weekend, he kind of says, well, maybe we can do a deal and all this bit manipulation kind of thing to this thing. But you have to understand, it's not, these things will be blips along the way. But the bottom line is that the US and China have to get along. They can't not. But when you have somebody like, Trump saying aggressively, we're going to put 100% tariffs and all this kind of stuff, the first reaction of everybody, be it if you're trading Bitcoin, equities, oil, potatoes, everybody just sells because it speaks to economic war. So you're going to have basically 3 more years of this. But I think the effects will be more and more muted over time. But US China is the big one because they run the world economy.
And Omar, looking on the point of view of, let's say, something like the events on Friday, or this sort of shock therapy we'd kind of, as I said to Victor, we'd sort of got sort of lulled into that the big trade announcements or the sort of insults or drama had kind of passed. I'm wondering, how are traders structurally set up for such a shock that could see such a move in the oil markets? Did a lot of people get caught with no clothes on Friday? Or how is the structural, how does one structurally set up for such shocks in the price architecture?
So basically, what happens is people will not take risk. So basically, anybody who had risk. So basically, the market is not moving in terms of anything to do with how markets should move. It's basically massive candles down and massive candles up, depending on on the whim of one guy. Now, if people, what you do is basically you mitigate risk. A lot of the people I'm talking to will tell you that, look, we don't know which way this market is going. If you look at the market since we printed that 55 low, we've been up, and then we've kind of had a series of inverted V's, kind of up, down, up, down, up, down, testing that general kind of area below between 62 and say 58. And we keep trying to break it, and we keep trying to rally. But I think what it does is it takes it damages both sides. If you believe that the US wants lower oil prices, then this constant kind of, we're going to put sanctions on and then no, we're not. And we're going to do this and then no, we're not. It will take a toll. I believe that at the end of the day, between now and the end of the year, markets in general will have a big rally. I really do believe that he does this so that he and his friends and whoever it is basically can position. There's no other way to explain the stuff that he says, especially that he keeps doing it on a Friday. So, and if you look at, I mean, the oil market is very different because it's large. But if you look at, for example, Bitcoin, selling started 30 minutes before he made his, announcement, his Truth Social thingy. And then as soon as he did, market dumps and dumps hard. So they were selling before, and not selling normally, but selling aggressively. So volume went up. And I think the same on equities 30 minutes before he said that, he's going to impose, when he said that China's not playing ball and all this kind of stuff. So there's a
So if you're
definite,
not if you're not in the privileged inner circle, you're the menu. If you're not at the table, you're on the menu. Michelle, let's just come back to some of the basics here. Big question about the scale of the OPEC plus increases in terms of the supplies that they've obviously been at this now 6 months. Quota increases 2.2 million second and third quarter, and now we're going through a series of incremental 100,000+ barrels a month of supply increases. Also having, you would think, a sort of dampening effect on prices, but nothing of great dramatics yet. I'm wondering how we're seeing that translated into tanker rates, into tanker shipping. This scale of more supply must indicate a demand for more shipping, unless these are empty supply increases.
Well, no, certainly over September, you saw those headline figures for very large crude carriers surpassing $100,000 a day. They did pare back a little bit to about $65,000 a day. That's on the spot market route from the Middle East Gulf through to China, which is the benchmark route to watch, because obviously China is the biggest importer. However, on the last couple of days, when the US announced some further sanctions on China, including some more VLCCs and some terminals, etc., and the introduction of retaliatory Chinese port tariffs on US owned or affiliated vessels, we've seen rates go up roughly, I think, 20%. Again, that volatility. And this is really a moving picture. I expect rates to have another big climb today, because if China does hold and these port fees are going to apply to publicly listed, US listed ship owners, that the fine print hasn't really been confirmed by China, but we're already seeing that's going to remove a lot of tonnage from the China market, and once again, that's going to see prices lift. And unlike some of the the argy-bargy that we've seen between China and US, where they have sort of backed down. I don't see China backing down on these retaliatory port tariffs because the US introduced their own tomorrow, and that seems to be quite fixed. So there's going to be another kind of trade war played out in not just tanker markets, but in the container and dry bulk markets as well.
Victor, maybe you can speak to that lovely photograph behind you. Are they all gone now, those containers? That is a outdated photo. How do you think, Victor, the sort of trade volumes, let's maybe start with imports of oil. We've seen over the course of the first 3 quarters, as reported by many secondary sources, that China has been building inventories at about 500,000 barrels a day. That was very much the headline at the APEC conference in Singapore. Is that sustaining in through the fourth quarter, that China will continue to buy for storage? You're on mute, Victor.
Well, September data just came out today, and we saw an average monthly import for the month, say 11.5 million barrels per day. And in the first
That's a big
9 months,
number.
in the first 9 months, the country's crude imports gained 2.6%, slightly up from 2.5% in the first 8 months. But when we look at the last quarter, the growth will probably slow down because of the sanction and lot of issues, and also quota issues. Independent refiners also running short on quotas too. And some state-owned refineries had actually cut their crude runs because of some issues. And so we expect to see a drop in the country's crude run in the last quarter. And probably we won't see such an increase in the last quarter.
When you say a drop, you're talking about imports that you would expect. You had 11.5 in September of imports. You would expect that to decline through October, November, December.
Yes, probably in the last 3 months of the year, it can drop modestly from this level. And 11.5 is just an average monthly for the past few months in 2025. And we still expect, for now, it's not declining much yet, but we can see modest declines in the last 3 quarters, so slightly below this level.
And that's certainly, even at these discounted prices that China usually is quite attracted by, low 60s on Brent, below 60 on WTI, that would be a very attractive price for China buying.
Yes, that would be attractive too. But it's mostly independents who take such discounted grades. And now independent refiners are still waiting for additional quotas. And some of them are short on quotas already. So they are probably going to cut the crude runs too in the last 3 months of the year, unless China announces additional quotas for them before the end of the year. But if it comes too late, say in November or December, they may not be able to hide their imports or crude runs.
Omar, are you still with us there on audio?
Yep.
Yeah. You said in your opening comments that you expect there still to be a rally through the fourth quarter. You could just sort of speak to that a little bit. We've got obviously this sort of weakening backdrop, and Victor indicating there maybe that the China buying might ease off in the fourth quarter. Where do you see the upward momentum coming from?
Look, I think if you look at the US, they need markets in general to rally. They need equity markets to rally. They need basically interest rates to come off, which is in itself a bullish impetus for crude and risk on and all this kind of stuff. So if you look at the background, all the stuff that Trump says is basically, it's kind of, head fakes. But the problem is that, you people have or traders have risk management. So you can't basically say to your boss that, look, we're not going to close if the market dumped by $3 a barrel, because risk will come and tell you, look, you have to close. But I think that, the US needs markets higher. And with the coming interest rate cuts that we're going to see, I think the chances of seeing an October cut are now up to 98%. So we're definitely going to see these cuts. We're definitely going to see higher prices in terms of everything, including crude. And the only question is, the only thing is, can you kind of hold on while Trump, does his antics, et cetera, et cetera? I think they're trying to basically have a kind of a unicorn kind of market with everything, including inflation, going up and with the dollar and oil going lower. But I think the bottom line is when, not if, in my opinion, when you see oil prices starting to rise, then that's really going to be the inflation genie out of, the bottle, and plain and, very, very easy for the whole world to see.
And on that point, Omar, I mean, you're talking there at your earlier comments that China and the US have to find a pathway forward here. And in the inevitability of that at apparently a meeting on the sidelines of a global conference in early November, that could be quite a relief rally in itself, just the fact that they're meeting and indicating positive vibes.
Yeah, I mean, definitely. But the thing you have to understand with Trump is that he's a showman and he always wants the spotlight on him. So I don't think this is going to be the kind of, it's like the same stuff that happened in Alaska with Putin. You get the kind of, yeah, we're going to have a meeting and it went great and we love each other. So I'm sure the same thing is going to happen to China. But the bottom line is the US cannot survive in the way it is now, with China having the upper hand on basically pretty much everything. And China has a chokehold on rare earths, and they will continue to use it. I mean, it's funny that Trump's complaining that China is using quote unquote illegal, whatever you want to call it, sanctions, tariffs, whatever you want to say, whereas the US has been doing it for years. So the bottom line is the US and China have to get along, but I think the trajectories of both countries is going to be totally different. China heading higher and the US heading the other way, not because one is good and one is bad, but because, China has invested in the right stuff, has basically a bigger population, has basically larger markets, and hasn't sanctioned half the world and weaponized the US dollar and sanctions.
Well, I
So
was
it's that simple.
rewatching Peaky Blinders last night, and the headline statement there was "Bigger eats smaller." That's the standard life in the jungle. Let's go to the survey question, and which is looking at this sort of OPEC position in all of this. OPEC Plus is redefining oil market management for a new normal with much less idle capacity. Agree or disagree? This shift of 6 months now from a 5-year post-COVID crisis management to now one where increases are happening regardless of the price point, not regardless, but ultimately in the face of a declining, weaker oil price window, that the new normal here by OPEC Plus is telling the world to get prepared, to get adjusted to a period in which there will be much less idle capacity. The 5 or 6 million barrels that we saw over recent years, if you take the announcements of the last 6 months, 5 minus 2.2 million is half of that or something like that. Michelle, your thoughts on that thesis? the idea that the oil price doesn't seem to be yet reflecting the fact that actually we could be moving towards a much tighter balance between supply and demand, with global inventories, putting China aside, but ultimately looking at below 5-year averages. Your thoughts of this shift from a period of ample idle supply, where even a war between Israel and Iran didn't push up prices, to now a period where we could be in a different prism?
You know what? I really can't find anything to explain the release of so much oil into a market when oil demand growth is slowing, and to see prices, remain more or less range bound. I can only conclude that geopolitics and volatility is having the desired impact, and that perhaps the OPEC strategy was a lot smarter than a lot of people might think, in that they've been able to reintroduce so much oil without having it really bringing oil down so much. I was looking at the September numbers. We had record oil exported, crude oil exported. I think was it 43 plus million barrels per day, and the price really didn't move the needle that much. I think once again that goes to China's buying strategy, and once that changes, as Victor says, in the fourth quarter, maybe we will see a reduction in prices. But then again, we've got geopolitics at play. It's really very, very hard. We were having a conversation before we went on the podcast where, the underlying fundamentals should be having a greater impact on the price than what we're really seeing.
Victor, you pick up on that. I mean, China's looking at the world, and obviously very driven by energy security. As the world moves towards a period of less idle capacity, and that idle capacity is basically within one or two countries. How does China typically react to that? One would think more buying.
Well, there was kind of expectation that China would continue to buy more than it consume in the coming months. But now things are changes, there could be some change over the coming months regarding their purchases. One is the sanctions, and another one is the quota issues with independence. And now domestic oil demand, fuel demand is not strong. So some refineries just took this opportunity to cut their crude runs. And exports are not high either, as you know, such as gasoline exports, diesel exports. They have been relatively low over the past few months, and still low in October too. So there is not such a need for China to increase its crude runs in the coming months. But when we talk about crude building, the country has been building stockpiles at least over the past few months, as we talked about. And the stockpile building can slow down in the coming months. Yeah. And there's not such
slow down. It has been about 500,000 barrels a day into storage, as reported by secondary sources. When you say that could slow down, are you saying that goes to zero, or what scale of slowdown do you think the storage build in China goes to?
Well, it might not be as high as 500. It might be just about 200 to 300, but there can still be some stock building in the coming months as prices are still attractive, as you said. And the country is also building tanks too. Some tanks are coming online in the coming months too. So there's still capacity for more building. But because of some other issues, the stockpile building can probably slow down from the 500,000 KBD.
Last word for Omar on that point. The survey question results showing a sort of overwhelming agree in this room, at least. How do you think the market's looking at that, Omar, that shift from a sort of number of years where there was just overwhelmingly ample, or at least the perception of ample idle supply, now starting to penny to drop, that actually maybe that's something very different now.
Yeah, I kind of, it always amazes me when people kind of, like to look at this very old-fashioned kind of supply and demand stuff. And then you get basically the fact that, if you look at the EIEA, they were saying like by Q4, we're going to get $59 Brent and by Q1 2026, 50. You know how they came to that conclusion? By counting, plus on this side.
It nearly went to
minus on this side.
$59 Brent on Friday.
Yeah. I mean, say again.
I said nearly hit 59 on Brent on Friday.
Yeah. But you have to have, the prediction was 59 in Q4 and 50 in Q1. The problem with that is if you look at the kind of, the market, if you look at the structure of the market, if you have prompt prices 59 now or 50 in Q1, that means basically that, further forwards, you're talking about oil at $30. It's nonsensical, and basically expecting prices to dip that much, in my opinion, based on counting stuff that today is this much and next week is this much. I mean, it's incredible. You'd think that, price moved on Friday $3 lower, right? The demand and supply move at all? Are they moving as we speak? When do you start looking at basically, if supply is going higher or lower? So my view is that all this stuff with supply and demand doesn't matter. How do I know? Because Trump says something and the market moves $3 a barrel, right? It's not like they're coming out and they're saying, yeah, well, today's more supply coming out for sure. So I think that supply and demand has a kind of thing. Everybody looks at the same balances. Everybody. I had a call last week where basically a company was giving us their view and they were like, energy aspects are looking at +2. Our numbers are +2.1. I mean, honestly, who cares? Because everybody starts with the same number. Everybody moves that number by plus or minus, 1% and comes and says, come and buy our analysis. And for me, counting is not analysis. So I think that oil prices are going to be driven not just by geopolitics, but by what happens basically with exogenous markets. In other words, what happens with the macro world. And that to me points higher.
Well, that to me points the end of our half hour together. So Omar can get back to the beach and Victor and Michelle can get back to work. Thank you, Omar, for plugging in. I appreciate you're on your break and
Thank you.
hope it's as everybody had hoped. Michelle, thank you so much for joining us. We look forward to seeing you again soon. And Victor, thank you as well. Have a great week, everybody. Oil prices trading up today, recovering from Friday. Will that sustain through the week? We'll see. All the best.
Thank you.
Everyone.
Bye. Bye, everyone.